Good morning. My name is David Chippy from Chippy Tutoring Services. Today, I'll be your teacher for accounts. However, the area of the syllabus that I'll be focusing on is one of the adjustment topics. Reason being is on the basis that this is a problematic area in regards to accounts. Students generally have this high problem analyzing and interpreting question regarding this area of topic, control accounts. So that is what we'll be doing this morning. So, control accounts is really simply an adjustment topics in accounts. It is just there to assist in the facilitation of preparing the final accounts. When we speak about final accounts, we're simply talking about the TP&L, or in other words, income statement or balance sheet. All right. Now, on top of that as well, control account is used for locating errors, because sometimes we have an incorrect figure, especially in regards to the sales account and the purchases account. All right. Now, so control account is used to locate errors. It is used to find your total debtors and total creditors. It is used to determine the final figure for sales or your final figures for purchases that will be later used in the different financial statements. All right? So we know that final account is also the same as financial statements. Now, first thing first, students, what you must know about control account is that we are really focusing, regarding to your CSEC syllabus, we're really focusing on the whole total debtor, total creditors ledger. Now, you would have learned that in subsequent topics that your your purchases ledger is simply used to record debtors. So that's where your total debtor will be extract from. Whereas, your purchases ledger is where you record your creditors. That's where they extract the total creditors from. Whereas your sales ledger is used to record your debtors. Again, students, the sales ledger, we have three types of ledgers, but the two ledgers that we will be focusing on is the sales ledger and the purchases ledger. Now, for the sales ledger, again, we record debtors. Or another word, another name for debtors is called your customers. Really and truly, customers is who you sell goods to on credit. You understand me? So hence, it's either called debtors or customer. Or the one that CXC is now getting more accustomed to is your accounts receivables. So it's very important, student, that you know the name association for debtors. All right. Why? CXC have a habit of interchanging these names. So sometimes they will refer to customer, sometimes they will refer to accounts receivables, sometimes they will refer to debtors. And again, these individuals or entities are found in the sales ledger. Again, you will also know that debtors is simply anybody or entity that owes the business. All right? Now we're moving on now to purchases ledger. Remember, there are three ledgers: sales ledger, purchases ledger, general ledger, but the focus regarding this topic will be on our sales ledger and purchases ledger. Your purchases ledger are used to record creditors, or in other words, suppliers. Why suppliers, students, is on the basis that these are people who we as business buy goods from to facilitate running our business. You understand me? So they are called suppliers, or another name, accounts payables. So students, it is very important that you get the association of the name because we will be using them interchangeably. Just as how you don't get it in your exam, CXC is going to do just that. Now, so control accounts, there are two types of control accounts that you must consider for your CSEC examination. The first one is the sales ledger control account, and the second one is the purchases ledger control account. Again, you see the names are interlinking, students. So we have the two type of control accounts: sales ledger control account and purchases ledger control account. So these are the two types of control accounts that you must consider. Now, students, remember I did say to you there are other names associated with debtors and creditors that you're already accustomed to. For sales ledger control account, remember it is used to record debtors. So the examiner at times may also refer to the sales ledger control account as total debtor control account or total accounts receivable control account or customers control account. They're all referring to debtors. Very important. Now, when it comes to purchases ledger control account, again, the examiner may refer to purchases ledger control account as total creditors control account, or you can say your supplier, total supplier control account, or accounts payable control accounts. These are the names that are associated with creditors. So in the grand scheme of things, students, in regards to this topic, the truth is that although control accounts is really wide, but remember now, students, we're narrowing on your syllabus, all right? So as it is now, we're only going to take control accounts being sales ledger control account and purchases ledger control account. Now, what I'm going to do next, I'm going to first focus on sales ledger control account. Students, I'm going to write a format of a T account of a debtor account. Now, the format, student, is not for you to SWOT. The format is just simply for you to understand the nature. Because as our CXC is really setting the exam today, is really testing you on your application skills, not to SWOT a format and you're able to write back what you did SWOT. It's not going to be that way. We can talk about it being that way in the earlier times during the exam, but no, it's not the case. All right? So first thing is my sales ledger control account. I'll be giving you the format, and again, not to SWOT. I'm going to give you the format for me to demonstrate to you so you can get a clearer picture of what is the sales ledger control account. So it's a T account, students, and I'm going to write, I have enough space for you to see. So you have your heading, sales ledger control accounts. And again, remember, students, they can also be named total debtor. So if you say total debtor, do not be confused, do not be alarmed. It's the same thing. If you say total customer control account, do not be confused nor alarmed. If you see accounts receivable control accounts, again, these are all the names associated with debtors that you must understand. Now, The sales ledger control account, student, is typically the T account that you are already accustomed to. All right? We would have learned T account from the early onset, the introductory stage of accounting. All right? Now, with the T account, we know that, okay, then, regarding asset, capital, and liabilities, how we record asset, capital, and liabilities based on the double entry ruling, which states that when you record an asset, any increase in asset is recorded on the debit side, which is the left side of the T account. Any reduction in asset is recorded on the credit side, which is the right side of the T account. Now, what you must also understand regarding sales ledger control account is that every item that is in the sales ledger control account are items that will affect the debtors. Now, debtors, as it is students, debtors is an asset. A debtor is an asset. Again, so we are now going to take on the whole double entry ruling of recording an asset. Now, the control account, students, is really known as a single entry topic, meaning that unlike the regular T account that you would normally be accustomed to from the very early entry of dealing with ledgers, you would have understood that you record two accounts for each transaction. But for this topic, it's called single entry on the basis that we're only focusing on a single T account. Irrespective of our focus, nonetheless, students, irrespective of our focus, we must understand the double entry ruling in order for us to appreciate single entry. So now let me go ahead and start doing the format. Now the year we're in is 2025. So I'm using that year. Kind of like to do what CXC love to demonstrate when they're presenting the exam to you. Now, the first thing, students, is that with your sales as a control account, we're going to record the opening balances. Now, again, student, you can start off a period with somebody owing you the business. You get that? Now, again, we know that debtor is an asset. Now, customary, student, it is known for debtor to carry a debit balance. Again, it's an asset. An increase in asset is recorded on the debit side. So therefore, any balance of debtors coming in is generally somebody who owe us the business, so therefore it carry a debit balance. Now, also, students, you will recognize that the debtor, the sales ledger control account, can carry a credit balance. Now, this may confuse you based on what I'm saying, because, you know, how sir say debtor carry a debit balance, but yet still, sales ledger control account, they have a credit balance as well. Don't be alarmed. There are reasons for this. Now, you have to remember the students that number one, we're not really dealing with a single debtor right here. What we're actually dealing with right here, we're dealing with total debtors from your sales ledger. So what you've seen, students, every item that you see inside here is really the aggregate amount of the total where it come up to. When you're looking at each individual debtor account and add them up, the total come right here. Hence, sometimes this is called total debtor control account, because it's really the aggregate amount you're interested in. So when I put an opening balance here, I'm not putting an opening balance of a single debtor in the business. I'm putting the opening balance of all the debtors in the business. So again, I give you the aggregate amount, all right? So now, the opening balance. So the period is a year, all right? So, and I'm going to make it easier for you, calendar year, all right? January 1. Balance. So the bal that is really balance. You would know that already going forward. Brought down or brought forward, and I put XXX right there. This is a debit balance. This is the general balance that you will see in a sales ledger control account. Now, if the examiner gives you a balance, if the examiner just give you a balance, an opening balance, and never tell you whether it's a debit or a credit balance, you, the candidate, must know that it's a debit balance on the basis that debtors carry a debit balance. However, if the examiner wants to tell you that there is a credit balance, the examiner have to be explicit in telling you that it's a credit balance. Is that understood? You have to be careful on this one, students. Again, sometimes the examiner will present the balance to you without indicating whether it's a debit or credit balance. When this happens, student, you must know that the balance regarding the sales ledger control account must be a debit balance. Now, if the examiner wants to indicate to you that the balance is a credit balance, they will have to explicitly state it. You get that? That this is a credit balance. Why? A credit balance for a sales ledger control account is not the norm. However, there are reasons why a sales ledger control account may carry a debit balance, a credit balance. One, when you, the business, sell the customer the goods on credit, that is, customer promise, you guys come up to an agreement that they will pay you at a later date. So for instance, you sell them goods. Today is what date again? Trying to figure that out. All right. So December 16 it is, right? So we sell the customer the goods on December 16. The customer then decides, okay, based on agreement between the business and the customer, they will pay you by the end of January in 2026. Now, January 2026 come on the 31st, they make full payment. Now, at that stage, the customer no longer owe you nothing. They had meet their obligation. Now, on a further date along the line, the customer realized that some of the goods that was actually delivered was damaged, or the goods was incorrect, or whatever the reason is why you may have to send back the goods, which we would know that that will be a return inwards, because the customer now returning the goods into the business. That's called return inwards or sales return. Because we sell the goods, customer return it back to us for whatever reason, incorrect goods, damaged goods, spoiled goods, whatever the issue is. Now, when the customer return the goods to us, the business, remember, student, that they would have paid us in full January 31st, 2026. Seeing that we have sell them the goods December 16 today, 2025. Now, in February, sometime in February, they return the goods to us. At that time now, students, we, the business, will then owe the customer who returned the goods to us for whatever the reason is. So hence, that customer will now carry a credit balance. Now, another thing that you're going to notice regarding your exam, student, is that if it is that the examiner is going to talk about two balances for the sales ledger control account, you're going to realize that the debit balance is always a larger sum, because that's the norm. And the credit balance, which is not the norm, will be minimal compared to the debit balance. Is that understood? Now, let me go now to record the credit balance. January 1. Balance brought down. Now, you may be wondering, candidate, students, you may be wondering, okay, sir, could it be that the examiner going to present to you that sales ledger control account only carry a credit balance? No. The norm is a debit balance. Now, what is not usual is a credit balance. So if there is a credit balance, automatically also there is a debit balance. However, there can be a debit balance, but no credit balance, none at all, because credit balance is not the norm. And again, we explain the unusualness of the sales ledger, which is the debtor, carrying a credit balance. So now let us move on from that. Then, now students, any other recording in regards to the sales ledger would have to be at the end of the period. Now here, I'm using a calendar year. The year start January 1, and I'm using the current year that we're in now, 2025. Clearly, it ends December 31st, 2025. So any other information going forward would then be at the ending date of the period. Another thing that you must understand, remember the double entry ruling regarding debtors, which is an asset. An increasing asset is on the debit side, which is the left side of the T account, which is the ledger. A decreasing asset is recorded on the credit side, which is the right side of the ledger. Now, candidate, what you're going to see, once I record anything here, it has to be an action that increases the balance of the debtor account. That is on the debit side. Anything that I record here would have to be an action that is used to reduce the debtor balance. Let me go now. Again, as I said earlier, the items that you will see, whether debit or credit, are all items that would affect the debtors. So December 31st, at the end of the period, now we talk about sales. Now I'm going to take my time, student, to explain to you every move I make. The aim is not for you to can swat it at the end of the day. It's for you to understand and appreciate the reason why I record here on the debit side as against on the credit side. And remember again, student, we must also remember the double entry ruling. Although these are called single entry, we must have the double entry ruling concept nonetheless for us to appreciate whatever entry that we made here. Now, here I record sales on the debit side of the sales ledger control account. Why? Based on the double entry ruling, students, if I sell a customer goods on credit, sales would be on the credit side, while the corresponding entry would be on the debit side. The corresponding entry would have been the individual debtor. Again, students, let me repeat. The sales that you see here, students, would have to be a credit sales. Although you don't see me put the credit sale, it's deliberate. I do not put the credit sales there. Why? Any sales that is in the sales ledger will have to be the credit sales. Cash sales can never, ever enter the sales ledger control account. Why? You will not record a cash sales in the sales ledger. No, cash sales is recorded in the cash book because the person would have paid for the goods immediately. All right? And again, for the person to be a debtor is somebody who you would have sold goods on credit prior. Good. So based on the double entry ruling, students, sales carry a credit balance entry in this regard. Corresponding entry would have been the individual debtor that carry a debit balance because the person would have now owe us the business. An increase in the asset debtor is on the debit side. They say once we sell them the goods, students, they increase owing us. We sell them goods on credit, they increase owing us. However, the goods stock is being reduced, so hence sale is on the credit side. The next item that you'll see here on the debit side, because I'm dealing with the debit column first. Ditto would have been interest revenue. That's the other item you'll see there. Now, how this come about, students? I mean, we're in business of making profit. Now, if you sell somebody goods on credit and they have not meet a particular timeline in payment as agreed upon, it's only fair for you to charge them. You, the business, will charge the customer an interest on the amount in which they owe you if they do not meet their obligation. So hence, interest revenue, because it's a revenue to you, the business, because I know it's not you, the business, being charged, it's you, the business, charge a customer. So hence, you will be collecting that revenue from the customer in interest. So revenue as it is carry a credit balance. However, the corresponding entry for the debtor account must be a debit balance, because the debtor would have interest revenue for us, the business. An increase in the asset debtor is recorded on the debit side. Now, another interesting situation regarding the debit side. So there, this is just ditto saying that same December 31st, ditto. You get that? And it's a very common practice with regards to your syllabus. You get that? So you don't necessarily have to write out December 31st all over again and again. Now, the next thing with regards to the debit entry, all right, we're going to talk about dishonored check or return check. Now, what is a return check? Remember, when you sell a customer the goods on credit, they then decide, we then agree that they're going to pay us at a later date. The later date come, they then pay you, they write a check and give it to you. However, when you take that check to the bank was unable to honor the check. And again, student, we call it bounce check, student. The layman term, it's bounce check, all right? But it's called dishonest check or return check. Now, the truth is that you go to the bank to encash the check that you have received from your customer, that is the debtor. However, you go to the bank and the bank is unable to honor your check or to cash it out for you. Why? One is either the customer do not have sufficient funds in their account for the bank to encash the check. Two, it can be that the customer have an expired date on the check. A check normally lasts for 6 months upon the date it was written, all right? So if the customer make an error and write a date 6 months futuristic from the 6 months prior the date that it is today, that check would have been known to be expired. Two, and thirdly, sometimes whatever the figure on the check is, it doesn't correspond with the worded figure on the check. So the bank cannot honor the check. So in this case now, the bank now return the check to you. So that's why it's called a return check or dishonored check. Now the reality is that, students, in your cash book, I'm just making a little excerpt here, your cash book. Now when a customer pay you, you just say, okay, we record the payment that we receive from the customer. So we say the debtor pay us X amount of dollars. However, if the check is bounced, we have to reverse that entry. Students, are you understanding what I'm saying? Again, I'm trying to make you understand and appreciate the concept of return check being on the debit side. All right? Now, again, if a customer pay us by check, we normally would record that check in the cash book. And this is it on the debit side, money coming in. Now, however, if the check is returned, that payment that we have received have to be reversed to say that it was null, it was void, it never happened. So therefore, we would say no, return check. And I put it in red to indicate to you. On the credit side of the cash book, to cancel out what you have previously collected. However, what will happen when we record the return check on the credit side of the cash book to cancel that receipt in check, we have to do the corresponding double entry ruling by putting it on the debit side of the debtor account. Remember, sales ledger is your total debtor. You get that? Good. So therefore, we put it on the debit side of your sales ledger control account. Now I'm going to move on now to the credit entries. Now again, we continue with the date, and the date that is December 31st. Now, discount allowed will be found on the credit side of the savings and control account. Discount allowed. Students, discount allowed is simply where we, the business, give the customer a cash discount. Why? We rewarding the customer for paying us on time as agreed upon, an extra or further discount from the trade discount if we have given them. So the discount, the cash discount, is a reward that we give the customer for paying early. Now, discount allowed is an expense. And like any other expense, students, like any other expense carry a debit balance. So since the expense account would have been debited, the corresponding entry must be credited. And we put the discount allowed on the credit side of the savings and control account. Then we talk about, remember we talk about return inwards. This is where customer would have returned the goods to us, no sir? Good. Now return inwards is simply where the customer bringing back the goods to us. Remember that return inwards carry a debit balance on the basis that the goods is an asset. Goods coming back into the business would increase the asset stock, and increasing the asset is on the debit side. So the return inwards account would have been debited. The corresponding entry must be a credit. Students, remember all of this I'm saying you would have learned in subsequent topics, but I'm here repeating it for you to appreciate the format so that it's not a thing where you're going to swat it. To swat it might be suicidal for you in the exam. Why? In the examiner may or may not give you all the necessary entry that I presented here. So you have to be very careful, students, on a matter of swatting this format. All right? So we have the sales return or return outwards. Same thing, students, which you would have already been introduced to. On the credit side of the sales ledger control account. Again, clearly, if the customer return goods to you, the business, they're going to decrease owing you. If you give them a discount as well, they're going to decrease owing you. So because those two items here decreases the balance of the debtor, a decrease in the asset debtor is on the credit side. Next thing, if the customer pay you by cash or check at a later date after you selling them the goods on credit, clearly, once you receive payment from the customer or the debtor or the accounts receivables, clearly they're going to owe you the business less. If they owe you the business less, it's a reduction in their balance. All right? So hence, the payment by cash or check by the debtor is recorded on the credit side of the control accounts. Now, it doesn't matter whether the examiner say cash payment, you receive money from the customer by cash or you receive by cash by check, same thing. However, but we know that when we refer to check, we're referring to the bank. So we normally say cash and bank, cash or bank. Even if the examiner use the word petty cash, because I've seen where the examiners use that petty cash was paid by a customer, but then students are kind of, confused because they're more accustomed to the word cash and not petty cash. It doesn't matter how minute, petty cash represents a minute amount. It doesn't matter how small, how large they had made payment. The reality is that once they make any form of payment to you, the business, that is, you would have received this payment. Because sometimes the examiner would use the word receipt from customer, $100,000 in cash or $100,000 in check, or we say $1,000 petty cash. It doesn't matter. They had made payment to us, the business, and hence the balance of the debtor must be reduced. So a reduction in the asset debtor on the credit side. Now, another thing would be of concern, apart from these, what we have here, is also known as bad debt. Bad debt. Now, what is bad debt? Students, bad debt is an expense. Unlike any other expense carry a debit balance irrespective of what the expense is. Once it's regarded or classified as an expense, it carries a debit entry. So the bad debt account will carry a debit entry, so the corresponding entry based on the double entry ruling must be on the credit side. Is that understood? Now, moving on. There is something that I need to say to you. The examiner kind of like to make trouble for candidates sometime. Now, if you ever see them use provision for bad debt, now, provision for bad debt is not entered in the sales ledger control account. Why? Provision for bad debt doesn't represent an actual debt that has gone bad. Unlike bad debt, is saying that somebody who owe you, the debt has gone bad. So you, the business, have to consume that cost. That's why it's an expense to you. So it's a done deal when you talk about bad debt. However, when it comes on to provision for bad debt, and which the examiner have this nasty attitude of putting it in the listing, and because you see provision for bad debt, you're going to take it and run with it and put it in here. But that's what exactly the examiner trying to elude you. But you must know that it should not. Why? Provision for bad debt can either be a revenue or expense, all depending on whether it's increasing or decreasing. It has nothing to do with an actual debt that has gone bad. It's just that you may theorize that, one little man when way down the road may not pay you because he either in a coma or a PR luck story might tell you. They said this one is not good, so you make a provision for it. You understand me? But you don't put it in there because it's not an actuality that happened. So be careful. That one must be noted, student. Again, the examiner will also try to elude you by putting in cash sales. You understand me? In the listing, cash sales can never go inside the sales ledger control account, student, on the basis that cash sales is simply where the person you sell the goods to them and they pay you immediately. So there's no reason to have the person name in your book. Because if you sell somebody and pay you and you have your money, you don't care about the name of the person anymore. The only time you care about them name is when them owe you, because you want to make proper recording. Simple. All right? So cash sales does not goes into the sales ledger control account, even though the examiner may want to try to elude you by doing that. All right? Now, continue here on the credit side. So we have bad debt, which is an expense. This represents some customer who had owed you initially, but the debt has gone bad. Either them had died or they have filed bankruptcy. You get that? So it's a done deal where the debt got bad. So you, the business, have to absorb that cost, and hence it's an expense to you. Expense is a debit. Corresponding entry must be a credit. So that's why it's there. Now we're going to move on to this one. When I speak about this one, sometimes students kind of find it funny based on my explanation. But bear with me on this one. You may too. Now, talk about set off. Now, students, the reality is that you're doing a business. Now, the person who is a customer to you may also be your supplier. It is possible. You can be a customer of PriceSmart because you buy your raw materials and so forth from PriceSmart to engage in your farm. So you buy bulk in salt in bulk. You buy, farm tools and all of that. You buy anything from PriceSmart that would use in your day-to-day operation. But yeah, PriceSmart have an agreement. PriceSmart have you as a debtor where they say, okay, you pay me at an agreed time. Likewise, although you are a customer at PriceSmart, you the same person, call yourself Joe Black. You the same Joe Black can also be a supplier to PriceSmart, meaning that you sell PriceSmart goods as well. You operate a farm, Joe Black Farm, and you may sell them pickled meat like pickled beef and pickled pork and all of that, pork ribs and all of that, because that's your farm. You get that? You sell them chicken and all of that because PriceSmart buy these things to then sell to customer. Again, you and PriceSmart have an agreement that these trading is done on a credit basis. So you may sell PriceSmart goods on credit as well as buy goods on credit from PriceSmart. So hence, PriceSmart will be both a debtor and a creditor in your book. Now, the reality is, students, is that, so for instance, as a debtor, PriceSmart owe you, let me use the black, I think you can more see the black from where you are. As a debtor, PriceSmart owe you, say, $50,000. Remember, debtor is anybody who owe the business. And as a creditor, PriceSmart, you, the business now, owe PriceSmart, say, $70,000. In other words, you owe PriceSmart more than PriceSmart owe you. Now, it depends on the relationship that you have established with PriceSmart over time. PriceSmart is saying, Joe Black, where the hell? Why you have to go write a check of $50,000 and me have to go, so them have to write a check of $50,000 to you, Joe Black, and you, Joe Black, have to write a check of $70,000 to them, PriceSmart. When you come to agreement, say, to hell with that, because check leave costs. You understand me? However, students, this don't happen with regards to, because some customers are very, you have to deal with them on a technical basis. You and them don't have that type of relationship. So, it's best if you write for your check and you collect for them check. But because of the relationship that exists between you and PriceSmart, when they decide, say, let us do some squixing. Remember them owe you $50,000, you Joe Black. And you Joe Black owe PriceSmart $70,000. When you look at the figures, it will be where really you owe them $20,000. You get that? When you look at the difference. So it squits out the $50,000 from that. So it leaves you back with $20,000. You owing them and they owe you nothing. You get that? So you just simply write your check of $20,000. Somebody save a check leave beyond the line. A reduction in cost right there. And believe me, student, check leave add up. All right? So it's cost effective. However, students, what I'm saying that this only happened regarding relationship that you guys have exists. So now set off is simply where you are reducing a debtor balance against the purchasing ledger. Remember, set off is where the person is a debtor and a creditor. So that you say set off against purchases ledger. So that whatever the person owe you, whatever you owe the person in purchases ledger, you would have then set it off against what they owe you in the sales ledger, that is the debtor. Is that understood? Again, the set off is simply where you have one individual who is both a customer and a supplier, and you decide that when you owe each other, you squits out. You get that? You must have that sort of relationship with siblings and anybody who you may think that you say, all right, me owe you, you owe me. Let us call it even and we go with merry ways. You get that? If it is that the amount that is owed on both parties is the same amount. However, if one owe in excess of the other, you just, whoever owe the excess of the other, pay the difference. Oh, again, I like to use one time gone, you have Claro, I have Digicel competing here in Jamaica. Well, Clara come here in Jamaica on the basis to give Digicel a whipping because Digicel entered their El Salvadoran market. You understand me? So you say, oh yeah, you will hurt me in El Salvador, me I come to Jamaica where you flourish to see if I can hurt you more. However, at the end of the day, Clara realized that they couldn't keep up. So they said to Digicel, say, okay, let us come to an agreement where we say, all right, whatever your asset and everything that you have here in Jamaica, whatever the asset I have, or you have in El Salvador, let us tally them up and squits out and we pay off who have the excess. You get that? And me, Clara, now leave the Jamaican market and you, Digicel, leave the El Salvadoran market. Don't trouble me, me not trouble you. You understand me? Although many people never like that deal, really, because customer kind of lose out. That's all, but that is what happens. Squits out. Moving on. Now, after you have done your recording, and this is just about the recording that you'll see regarding the sales data control account, you're now going to focus on now balancing off. Now, again, the balance, the closing balance at the close of the period can be a debit balance only, or it can be a credit balance. So the closing balance can be both, or it can be both balances, or it can be one. If it's both balance, you have balance CD on the debit side here and balance CD on the credit side here to bring them down after you tally up. However, if it's only one balance, it must be a debit balance likewise. Why? The norm of a sales data control account balance is simply a debit balance. So let me write the balancing off and we explain to you how you go about with the closing balance as well, because this is very, very important. Although you would have been learning balancing off from the early onset of TP&L. Moving on. If you notice I have CD here, the CD is just to equate both sides, to have the debit and the credit side equal, all right? Now, in most cases, students, the examiner will indicate to you, whether by implying or by stating explicitly that there is a credit balance, okay? Now, let me explain the balance carried on here, because you guys have, because this is where many of you now falter. It's, even if you have gotten the whole concept of where to record where, because some people still go about swatting, even though I'm saying this to you students, that's not the way to go. It's best if you understand the nature of how we record the necessary entry, rather than trying to say, okay, let me swap the format. You don't have the format in the exam. Students, why you going to do it? All right, moving on. Now, students, if it is that the balance is a debit balance, your closing balance, that is at the end of the day, it's a debit balance, the CD has to be on the credit side. Why? When you're speaking about balances of an account, what you do to determine whether the balance is a debit or credit is not the CD, is the brought down. The brought forward or brought down is what you use. The CD, again, is just simply used to equate both sides. So if the examiner gives you a debit balance at the close of the period, you must know that the corresponding CD must be on the credit side. Because when you do your tallying up and bring down, you're going to see that you bring down this balance on the debit side. And this is where you take it from, that the account will carry a debit balance. So the CD of the closing balance goes on the opposing side. And this is very important for you guys to understand, because when we're dealing with T accounts earlier, we're balancing off T accounts, realize that if the accounts carry a debit balance, the CD is on the credit side. If the accounts carry a credit balance, the CD is on the debit side. And you must follow that just the same. You see, just as though I'm telling you this for sales in the control account, there is another topic, accruals and prepayment, that again take on the same concept, which that is many students' confusion. But let me continue now. So now I'm going to tally up both sides. Remember, when you tallying up T accounts, you ensure that it's on the horizontal level. The both sides is on the horizontal level. So although this side has more information on this side, we don't put the tally line right here. No, we put the tally line in the same level as the side that have more information. It must be level. Remember, the other characteristic with accounting is that the work must be neat. You understand me? It's good. And we then tally up, and then we double line to close. Double line to close. We're closing the statement. Again, students, when you're tallying up, the tally must be on the same horizontal level. If it's not on the same horizontal level, students, you are missing the principle of it. All right? As the subject is principle of accounts, the way in which we are going to do our accounts. All right? And this is one such. Now, after you tally up, you're now going to bring down the closing balances, the CD, into the new period. If the period ends December 31st, 2025, the next day immediately after such date would have to be January 1, the new year, which is 2026. So that means we'd have to record the year, the 2026 year. So this CD here will come here. Mark it as it is now. You're not really seeing the contrast because they use X dummy value to represent the figures. So they're not noticeable, but whatever the balance CD here is what bring down over here. So we have January 1, because that's the next day. Balance brought down or forward, XXX. So this debit CD here come on the credit side as they brought down, January 1. Balance brought down or forward, and we have XXX. And that will be your sales ledger control account. Candidate, make note of what I'm doing. Yes, I write the format for the sales ledger control account. However, if you watch the optics of me demonstrating here, I give you the reason why everything is placed on whatever side. Okay? That must be taken into consideration. Otherwise, you are going to have a warm time with this subject. All right? Or this topic, rather. Now, let me go on now to... So we have done the sales ledger control account. The reason why I make sure I go off of this one, this is the bigger one, and it takes more into explaining. Now, the purchases ledger control account is generally not so as compounded as the sales ledger control account. All right? So that's why I deal with this first, to get that out of the way. All right? So now, I'm moving on now to the sales ledger control account. Moving on now from the sales ledger control account, we're moving to the next one, purchases ledger control account. Not as compounded as the sales ledger, but concept is pretty much the same. All right, moving on. So I'm writing the T account as well. I have this space, I'm using it up. So purchases ledger, control account. The year, current year, 2025. Good. And we're using the calendar year just the same, starting January 1 and December 31st. Now, just as I did with the sales ledger control account, listen carefully with regards to the purchases ledger control account. Now, again, the other name that you'll see the examiner use regarding the purchases ledger control account. One, the examiner would say at times total creditor. Again, creditor is found in the purchases ledger, and hence the total creditor control account can also be used in fact, the examiner will use it, by the way, so you have to get used to the different terminology. Or they will tell you total supplier control account, because supplier is the same thing as creditor. Or the examiner would now go to it's like CXC, find a new name, and then there have been rings in it, students, and that is accounts payable. The debtors is accounts receivables, creditors is accounts payable, because we're looking forward to pay these person who we owe. Accounts receivable, debtors, we are looking forward to collect, to receive from these person who owe us. All right, moving on. Now, just as how the sales ledger control account may carry two balances, it's the same principle with regards to the purchases ledger control account. Again, now I'm focusing on purchases ledger control account, which is the total creditor, student. So follow me on this one. We have just done debtors, we're now on creditors. All right? What you see right here, any information right here, this represents all the aggregate amount in value that affect creditors. We get these information from the purchases ledger, hence the name purchases ledger control account. Creditors are found in the purchases ledger control account. As it is, students, creditors carries a credit balance. A creditor is classified as a liability. This is somebody who we, the business, owe. We are liable to these persons. You get that? So, based on the double entry rule in now, students, it's very important, although these are single entry, it's very important that you get the double entry rule in with regards to liability. With regards to asset, as we have spoken earlier, an increase in asset is on the debit side, a decrease in asset is on the credit side. Fast forwarding now to creditors, which is liability. An increase in liability is on the credit side, and a decrease in liability is on the debit side. It's like the reverse. All right? Now, but this, as it is, student or candidate, is the same principle that you would have known from the earlier introductory phase of accounting. All right? Moving on. So now, the first thing we're going to do is show both balances. I'm going to explain both balances just the same. So we said January 1, balance brought down or brought forward, XXX. Just representing figures. Likewise, on the credit side, January 1, balance brought down or forward, XXX. Now, here's the thing, candidate. The norm, what is supposed to be the balance of a creditor account is a credit balance. This is the norm. This is simply the norm. That is, if the examiner should ever give you just a single balance without even telling you whether it's a debit or credit, stating it's a balance of the purchases ledger control account, you, the candidate, should know without any reservation that the balance is a credit balance, because that's the norm of a creditor balance. If the examiner give you a debit balance, they will have to imply or explicitly state it that this is a debit balance. Again, this is not of the norm. And because of that, you will always notice that the figure for the credit balance of the purchases ledger control account is way larger than the figure for the debit balance of the purchases ledger control account, on the basis that the credit balance is the norm, the debit balance is the unusual activity. And again, the reason why a creditor may carry a debit balance is simply on this simple basis. One, we, the business, we buy goods on credit from the supplier/creditors. We agree that we're going to pay at a later date. When the later date comes, we, the business, had made payment. Now, once we had made payment in full for these goods that we have initially purchased, we no longer owe these persons. Them not owe we don't owe them. Blank. So no balance at all. However, at a further later date, we, the business, has now discovered that something is wrong. They may deliver to us an incorrect good, or during transit the goods may damage, or the goods is spoiled, or whatever the reason is why we, the business, now have to now return the goods to the supplier who we buy it from initially. And this is called a return outwards, because we return it back, we return it from the business, out from the business, back to the supplier. Or the other name for return outwards is called purchases return. Now, in this regard, student, because we, the business, have already paid these suppliers/creditors earlier, and now we are then returning some of the goods to them, those supplier or that supplier would then now in turn owe us, the business, for the goods in which we have returned. Again, it's the same principle as I gave with regards to sales ledger control account with debtors. Why is it that a debtor may carry a credit balance? So I'm explaining to you now on why is it that a creditor may carry a debit balance, which is the unusual norm. Unusual, not norm. Strictly unusual, no norm. Norm say that, boy, this is the way how it go. All right, moving on. Now, continuing now, students, I'm going to have now the other entries. I want you to follow me and don't lose sight of what I'm doing. Now, based on the double entry ruling, an increase in liability, which is the creditor in this case, is on the credit side. However, a reduction in liability is recorded on the debit side. So any item that I put on the debit side of the purchases ledger control account is to reduce the balance of the creditor. And any item that I put on the credit side of the purchases ledger control account is to increase the balance of the creditor. Students, candidate, you must understand those simple rules. Now, moving on. So now we're going to record the items that would affect the creditors, and only the creditors. So here it goes. We're putting it on the ending date, calendar year. If it starts January 1, it ends December 31st. So here we go, December 31st. We have cash or bank. What is this cash or bank? Now, this cash or bank on the debit side is where we, the business, had paid the supplier, the customer. Now, students, Remember, regarding a cash book, are you seeing me, students? Regarding a cash book, when we, the business, make payment to a supplier, in the cash book, it's recorded on the credit side because money coming out of the bank. Clear? Let me go again. Again, this recording here of cash or bank indicates that we, the business, had paid the supplier. Now, again, although this is single entry, to understand the single entry, we must understand the double entry ruling. Now, when we record the payment that we made to the creditor in the cash book on the credit side, the corresponding entry must be a debit. And look at the grand scheme of things to students is that if we, the business, pay somebody who we owe initially, the logical sequence is simply where we're going to reduce owing them. And hence, a reduction in the balance is on the debit side of the purchases ledger control account because you're dealing with creditors. Now, moving on now to another item. Discount received. Discount received, students, is a revenue. Why so? Here's why. Discount received is where we, the business, were given a cash discount by the supplier on the basis that they are rewarding us for early payment. So because we owe them and we pay on time, them say, you know what, for your prompt payment or on-time payment, here's a little thing. They give me a discount. And so if I should pay $1,000, they give me a discount of $100, so I just pay them $900. You get that? That $100 is really a revenue to us. Because we should have paid over $1,000, but the supplier gave us $100 as discount. So therefore, that is a revenue to us. Now remember, students, revenue carry a credit balance. Revenue is a credit balance. So therefore, if the revenue is a credit balance, the corresponding entry based on double entry ruling must be a debit. So you must follow the double entry ruling, and careful note must ensure that you are. Now again, we ain't swatting this, students. We are understanding the nature of every action that we took in order to record these entries. Now the next one, student, is our return outwards account. Now, return outwards is simply where we, the business, return the goods to the supplier who we had bought the goods from initially on the basis that we're not really satisfied with the goods. Incorrect, damaged, spoiled, whatever the reason is, we're not satisfied, so we bring the goods back to the supplier who we had actually bought it from initially. Now, here's the thing. The good stock, which is an asset, would reduce. So hence, return outwards carry a credit balance. If the return outwards accounts carry a credit balance, the corresponding entry must be a debit. And that must be very important for you, students. You're following the double entry ruling. All right? Now, the other thing to student is one more for this side, then we go over the debit side, the credit side. We have set off, just as though we have set off in the sales ledger control account, we have set off in the purchases ledger control account. And again, from the same very reason I had explained. For those of you who are just joining, let me just say this again. Set off. No, again, you are operating a business. You're going to have debtors, you're going to have creditors. And yes, it is possible that one individual who you do business with is both a debtor and a creditor. Why? They are a customer to you, and they're also your supplier. Going back to the farmer Joe, example regarding Price Mart. Farmer Joe is the business, Price Mart is the customer slash supplier. Farmer Joe buy materials to carry out the day-to-day activity of his farm from Price Mart and credit. Price Mart, Farmer Joe then owe Price Mart. In that case, Price Mart will now be a creditor. You get that car? Farmer Joe owe Price Mart. So Price Mart, the creditor. However, Farmer Joe likewise sell Price Mart goods on credit just the same, because Price Mart buy meats, whether it's pickle, whether it's frozen chicken, pork, beef, whatever it is. Farmer Joe sell Price Mart on credit, so hence Price Mart, PM, Price Mart, the debtor. So Farmer Joe owe Price Mart, in this case, say $100,000. Price Mart, who is a debtor, owe Farmer Joe, say $90,000. Likewise, students have, like earlier, depending on the relationship that both the business Farmer Joe have with Price Mart, they may agree to say, when the hell it was, we're going to write 2 check leaf for, pay 100,000 for one and 90,000 for one. We just quit out and whoever have the excess pay over to that person. Simple. 1 check leaf rather than 2 where I write 2 check leaf. A reduction in cost in operation right there. All right? And these are very important, students. You get that? However, if it is Price Mart was that person where Farmer Joe and Price Mart don't really take tea. 2 of them are going to say, you know what, you write for your blasted check. And me write my own. In that way, we don't have no issue with who pay who. You understand me? But if it is a case where we can say then, okay, Price Mart, me owe you 100,000, you owe me 90,000, but we quit out the 90,000. So, zero, take out the 90,000 out of that, me only owe you 10,000. So me just write you a $10,000 check instead of $100,000. Price Mart say, all right, cool, Farmer Joe, nice doing business with you, shake hand, move on. You understand me? Maintain relationship. So, again, this is called set-off. If you notice the set-off both reduce the debtor balance from 90 to 0, and it reduced the creditor balance from 100 to 10, both reduction. Now, in the sales ledger control account, which represents debtor, you notice the set-off is on the credit side of the sales ledger control account to indicate that the debtor balance is being reduced. For the purchases ledger control accounts now, students, we're going to realize that the set-off is on the debit side because any debit entry would have reduced the credit balance. You get that? And as can see there, based on the demo that I give you with regards to the figures. So hence, the set-off against the sales ledger is recorded there. So now, as I did tell you students, the purchase ledger control account is not as compounded as the sales ledger control account. So I'm going to move on now over to the sales ledger, to the credit side of the purchases ledger control account. The end of the period, December 31st. We are going to talk about purchases right here. Why? Here goes. We, the business, buy goods on credit from our supplier slash creditor. What will happen, students, is that the purchases account is goods coming in. So you're going to record on the debit side of the purchases account. So based on the double entry ruling, because you record on the debit side of the purchases accounts, you must record on the credit side of the creditor account. So that's why purchases come on the credit side of the purchases ledger control account. Another thing you must understand is that if we buy goods and credit from a creditor or a supplier, don't we go owe them more? So that will increase the balance of owing, no sir? So that's why the credit balance, our credit entry would increase the balance of owing to the supplier. Now, moving on to the other one, where we're going to have interest expense. Now, interest expense, students, is where the supplier charge us, the business, for not paying on time, not meeting our obligation. You get that? We take too long to pay, so then say, you know, charge you an interest on the amount. But all of this will be really in the agreement and so forth, you know, that you're signed to. I must tell you. You get that? Now, it would be an expense to us because it's a charge to us, the business. You get that? Expense, as we know it, carry a debit balance. Again, students, this must be a reminder for you guys, because this topic, the adjustment topic, we would have to do all those elementary topics for you to understand the adjustment topic. All right? So, interest expense. Expense carry a debit, so the corresponding entry must be a credit. So the interest expense is recorded there. Now, one student may ask, then sir, just like we have this on a check or return check in the sales ledger control account, why we can't have it in a purchases ledger control account? Now, students, listen up. The return check is simply where a customer paying us by check, but their check is bounced. We, the business, we're not going to make no provision so we're going to pay somebody on the check bounce. No, we're not into that, because as far as we can, so the check big you solid as a rock. You go to the bank and you cash it and you move on your merry way. So we don't have this on a check in regards to purchases ledger control account. Because, I mean, I wish business are create, and you make plan fit, you make provision, or you make some sort of thing where you now got your check go bounce. No, man, if you see that in your book, man, stay for 5 years business, you're presumptuous too. Part of it if you do that. So we don't do that. You understand me? Good. You can control how a next man operate, you know, but you can control how you, the business, operate. You understand me? Good. So, we don't see that in the purchases ledger control accounts. Now we're moving on. Now, after that, students, likewise, we're going to talk about the closing balances for the purchases ledger control account. Again, the closing balance can carry 2 balances or 1. If we carry 1 balance, likewise, we should know that is a credit balance. Now, moving on. So we have balance CD XXX over here. And again, I'm just making the provision if it's 2 balance. So, and then we now tally up. So remember, student, if the closing balance is a debit balance, the corresponding CD must be on the credit side. You get that? If the closing balance is a debit balance, because you're going to bring it down on the debit side. And remember, student, is this closing balance, whatever the brought down is, that tell you what type of balance it is. The brought down tell you whether it's a debit balance or a credit balance. The CD, no. The CD just equate both sides. That's what the job of the CD is. You get that? Ball CD. Good. So now we're going to tally up, ensuring that the tally lines are on the same horizontal level. So therefore, these are missing rows. Do not put the tally line there, students. You're wrong as hell. You get that? Moving on. So you must have the gap there, students. That's the principle of writing the accounts. All right, so here we're going the total here and double line to close the statement or the account. Then now we're going to bring down in the new period. Remember the day after December 31st, 2025 must be January 1, 2026. So therefore, we're going into a new year. Now the balance CD on the credit side is then brought down to the opposite side, which is the debit side. You get that? So we have January 1, BAL, BD are brought down or brought forward, would have been XXX. This balance CD on this side is brought down over this side here. The balance CD on the debit side is brought down on the credit side. So we have January 1. Brought forward or brought down, XXX. And now this will now be your purchases ledger control account. Again, let me warn you. Let me warn you. Now, the truth is that you swatting this ain't helping you, not going to help you. Do not swat it. Understand the nature of it, and in that way, you're very good to go. I'm just going to quickly, because time is against me, I'm going to quickly go through just a one question. Now, here the examiner give me a question where just going to walk you through this to the students. So listen up carefully. They said that the trial balance of B. Blake at 31st of December 2006 reveal a difference in the books. What that means, the debit column of the trial balance does not agree with the credit column of the trial balance. In other words, they don't have the same amount. You get that? Which trial balance, they have to have the same amount. All right? Moving on. In order for that error to be located, she decided, that is B. Burke, decided to prepare purchases and sales ledger control account. Now, from the following information, prepare the control accounts and indicate where the error or where an error may occur. Now, students, the examiner may give you a listing, and they may give you a listing with everything relating to purchases ledger control account and sales ledger control account mix up. And you then have to then pick out which one is relating to the customer, which one is relating to the supplier. You get that, student? So you have to understand that. So let me here the balance. Just listen me out on the balance. So here they give me a purchases ledger balance on January 1, 2006. They don't tell you whether it's debit or credit. So you know that because it's a purchases ledger balance, it must be a credit balance. You get that? Because credit carry debit a credit balance. Then they give you the sales ledger balance as of January 1, 2006 for 19,744. Again, they don't tell you whether it's a debit or credit, but you, the candidate / student, should know that that must be a debit balance. If they want to indicate the abnormal balances, they have to indicate it. You get that? But explicitly or implied. Now, the other balance that they give you is a purchases journal. Now, I said these are things that would kind of trick you, you know. But you must understand that you would have done the you would have done the different journals. All right? We know that if they speak about purchases journal, that must be the total credit sale, the total credit purchases. Once it's a purchases journal, so if you look for the word credit purchases at all times, you're going to be confused. The examiner will just tell you purchases journal, and that's an indication that it is credit purchases. They will give you sales journal, and that's an indication that's that credit sales. The examiner will also give you cash sales or cash purchases, and you should know that the cash sales or cash purchases that does not go into the control account. Moving on. Return outwards journal would have be a total return outwards. Return inwards journal would have be a total return inwards. We know that return outwards refers to the creditor because we, the business, return the goods back to the supplier, which is the creditor. We know that the return inwards journal refers to the debtor on the basis that the customer who is the debtor return goods that was previously sold by us back to us. You get that? So that's return inwards. Now, checks paid to supplier. Once I said supplier, remember I tell you the names that they will tell you? Suppliers, creditors. You get that? So, checks paid to creditors. Clearly, if you make payment by check to creditor, you know that where it got based on the formula that you have given. Now, petty cash paid to supplier, likewise, once you're making a payment to supplier, you know where it goes based on the formula that I'll give you with the explanation and reason behind it. Then we talk about check and cash received from customer. If you receive that from customer, once it relates to customer, it must be debtors. You get that? So you know where that goes, decide in the sales ledger control account. Then we speak about discount allowed. Again, students think. You have to get into the habit of thinking and stop just look on term and just don't understand what it means and the significance of it. Stop it. It's not going to help you. This exam is a matter of how you can apply yourself, apply your knowledge, not swatting. You apply your knowledge because you know that discount allowed is an expense because we, the business, give the customer the discount. That's what discount allowed is. Discount received now is regards to the creditors on the basis that is the supplier who give us, the business, the discount. Is that understood? So you see, if you don't take these things into consideration, students, control account as you know it will be misery for you. Not that it has to be. You choose to have it to be a misery for you. So think about what you're doing. All right? Moving on. Bad debt written off. Again, bad debt. Who would have been bad debt? It don't have to be the debtor who owe you the business. You understand me? I don't like you the business. I plan to be a bad debt to somebody else. You're mad? If you make that provision and me ever pick up that in your business, me not do business with you because you plan to be all crosses to me already and we don't want that. All right? But sales ledger, in the sales ledger control account, the bad debt must be the customer because you can't control the customer. You can control you, but you can't control the customer. So the customer may go bad. The customer may die or they go bankrupt. So the bad debt, so you absorb that. So once you hear bad debt, it refers to the debtor, which is the sales ledger control account. Again, once you hear customer check dishonored, again, customer has to deal with debtors. That's all. Has to deal with debtors. So therefore, students, likewise, again, that would have to do with the sales ledger control account that customer check dishonored. And then we have contra settlement. Contra settlement between sales ledger and purchases ledger is the same set off. Set off is regard to a contra settlement. You get that? Now let me quickly, students, with the time that I have left, let me quickly deal with the sales ledger control account. Now I have to now do it smaller on the basis that I'm doing both of them at the same time. So this is sales ledger control account, purchases ledger control accounts. The year that they give is 2006. So we say 2006. Student, make it a habit to do the right thing. Make it a habit in accounts to do the right thing. Now, first, in this case, students, they gave us only one balance. Luckily for you, one balance. So you don't have to worry how the unusual come in. You get that? Although you should not, because you get the explanation on it. Moving on. Purchases ledger balance. They give us 11,874. So we say January 1. BAL, BD, the opening balance, 11,874. Remember, they don't tell you what balance it is, because you must know that if the examiner give you one balance for the purchases ledger control account, it has to be a credit balance, because these are creditor. Then they give you the opening balance for the sales ledger balance at January 1, 2006, 19,744. Again, one balance, you don't have to worry which one goes where. It must be a debit, because these are customers. Debtor carry the norm is the debit. January 1. So this must be January 1. Balance BD 19,744. Now, Again, they say purchases journal. Clearly, you can't look for sales ledger. Purchases journal would have to deal with the credit purchases. So that's creditors. Now, purchases journal is a credit purchase. Purchases carry a debit, so the corresponding entry must be a credit. At the end of the period, December 31st, purchases. And you don't have to indicate whether it's credit or not, because our only credit can even can go here, 154,562. Then we talk about the sales journal. Sales journal represent credit sales. Who we sell goods to? Customers. You get that? Customers is debtor, so it's a sales ledger control account. Again, sales carry a credit entry, so the corresponding entry must be a debit. Students, you realize I'm not swatting. I'm using my knowledge of double entry ruling to indicate where I place the item. So that is 199,662. Then we talk about return outwards. Return outwards refers to the supplier, which is the creditor. Return outwards carry a credit balance, so therefore the corresponding entry must be a debit in the purchases ledger control account. December 31st, return outwards would have been, return outwards is 2,648, 2,648. Now for the return inwards journal, return inwards represent customer bringing back the goods to us. These are debtors. Customer is a debtor. So say that the control account return inwards carry a debit balance, corresponding entry must be a credit. So therefore, December 31st, return inwards. Just shortening up for now, return inwards, which is 4,556. Then we have checks paid to suppliers. Checks paid to supplier have to do with the creditors. So over there, so creditors are over there. So you get that? Purchases ledger control account. So checks paid to supplier, 146,100. If you made a check payment to supplier, you're going to owe them less. A reduction in the liability creditor is on the debit side. December 31st, bank. So when you talk about check, you're referring to the bank. Bank is 146,100. Then we talk about petty cash paid to supplier. Again, we're still making a payment to supplier. That has to do with the creditors, which is the purchases ledger control account. Here, cash. Or if you want to say petty cash, no big deal, $78. Then we talk about check and cash received from customer. Once you speak about customer, it's related to debtor. Debtor is found in the sales ledger. You get that? Now, if you receive the cash and check in the cash book, it's on the debit side, so the corresponding entry must be a credit. So, cash and check, so cash and bank in regards to the customer is 185,960. Then we talk about discount allowed, is where we, the business, allow discount to who? Must be the customer and so, because then we sell goods too. So discount allowed is an expense carry a debit, so the corresponding entry must be a credit. So that's discount allowed. All right, so which is 5830. So students, the gist of it, what I want is for us to get how we record it, and then you can do your own balancing off after that. All right, moving on. Discount received is a revenue. Discount received refers to where we receive discount from our supplier, which is our creditor. Discount received is a credit balance, so the corresponding entry must be a debit. Discount received. Discount received 2,134. Bad debt written off. Bad debt written off has to relate into the debtor, because for them debt will go bad. You get that? So therefore, bad debt is an expense. Expense carry debit, so the corresponding entry must be a credit. Bad debt. However, provision for bad debt does not go here. Students, don't get confused with that one. 396. Then we talk about customer check dishonored. Again, a dishonored check is reversing the entry that you have received from customer. You get that? Thereby reinstating back the customer's debt. A customer's debt being reinstated means that it increases the debtor balance, so it's on the debit side, which is return check. and the return check is $30. Then the last one, student, contra entry settlement between sales ledger and purchases ledger. All right. So now contra entry is where both account is affected. So contra entry, which is the set off, will reduce the purchases ledger, reduction in creditor liabilities on the credits on the debit side. So we have set off against sales ledger, and the amount is 1,036. That same set off is used for the sales ledger control account to reduce the sales ledger as well. Debtor being reduced is on the credit side. So here it goes. So we have set off against the purchases ledger, 1,036. And then students, they said that at December 31st, the list of balances were given. Purchases ledger is 14,530. Because purchases ledger carry a credit balance, the corresponding entry must be a debit. So the BAL CD, we're just doing this and we stop right here. BAL CD for this one is 14,530, while for the balance for the sales ledger is 21,658. It's only one single balance. We know it's a debit balance. So since that debit balance, the corresponding CD is on the credit side, and we stop right here. Amounted to 21,658. And there you go now, students. All you have to do now is to apply yourself and then go ahead and total both sides, close off, bring down the balance, and you're good to go. Again, students, remember, do not swat it. It won't help you understand the nature of every entry, which you would have had some backdrop from the earlier time. Have a good day.